Good morning. Welcome to my e-learning channel YouTube. Where in this video today we are going to be discuss about mutual funds. Basically, mutual funds, and we have to be aware about the concept mutual fund. Has to be know about that mutual fund. It is one of the alternatives or one of the options of investment avenues. So let's discuss about today's videos mutual funds. Basically, in this videos, I am going to discuss about mutual fund product and services. Under that concept, types of mutual funds, where going to be learn about mutual funds. So basically, when we discuss about mutual funds, we'll go for that syllabus point of view as per Anichanama University, unit number 4. That these number of contents they are added. So they are going to be going. They are added open-ended and closed-ended funds, equity index, diversified, mid-cap, large cap, then sectorial, hedge fund, exchange traded fund, arbitrage, MIP, FIP, and capital protection oriented schemes. So basically this unit we have to discuss about unit number 4 related to only mutual fund product and services. Means what mutual fund products and services are available for general publics, where they are going to be invest and they are getting the return from short term and long term period purpose. Before going to this mutual fund concepts, we want to be learn about that what is mutual fund and why we want to be focus or why we want to be select mutual funds. Now before going to the mutual fund, we comes to know that when the word comes mutual funds, the advertisement comes to the picture, that is it is subject to market risk. Please read the offer document clearly before making investment. And one more important advertisement, that is we have to aware about that mutual fund sahi hai. Now everyone wants to invest in stock market, will get more returns, but they does not have complete knowledge. It is not necessary. And to be invest in mutual funds, they has to be thinking about that the complete knowledge is required. But to be invest in mutual funds, basically complete knowledge is not necessary. Investor want to take a risk, but they does not have knowledge, so that's why they will not invest in a stock markets. And to manage this kind of risk purpose, one asset management company is formed that we called as a AMC basically, and the work is to manage asset, means to manage the fund of public. So here the public in general given money to asset management company basically, and on behalf of public, AMC will invest money in stock market. In that stock market, equity, debt, balanced portfolio invested, and portfolio composition, they will add or less security when to buy or sell. People does not have any knowledge, and they will given that assurance to public for their investment. We manage money through AMC, and they will tell to that general publics how that mutual fund considers. So basically mutual fund is the trust of pool of saving of number of investors who share a common financial goals. Now how this mutual fund has to be work, basically now general public come to that AMC, they will contribute to the money, and they will be given that criteria AMC, that how much risk you want to be take, how you want to return patterns as a regular pattern, including dividend or lump sum amount in future date of investment. Criteria investment it is based upon the objective should be informed. How much risk how much risk you want to take according to AMC will make a plan and manage money. Means ultimately AMC will decide that how much return you want or how much risk you want, and based upon investor objectives they will give the plan and they will manage the money on behalf of general publics. And AMC will not manage the public money without free of cost, so they will charge obviously the percentage of commissions. So it was always place a charge from client or customers, because they are going to manage the public monies and they are taking the risk on behalf of public, so they will charge some things. And when public has been contribute his money to AMC, they create a fund, and that fund is called as a mutual funds. No, when public has been contributed to AMC, they are creating the funds, and that fund is called as a mutual funds. So public contribute money to AMC, that is in the form of unit only. That is very much important as a part of mutual funds. And mutual funds are divided into units, that is face value of rupees 10. Suppose if a person invests rupees 1 lakh, so he is going to be purchase 10,000 units. How that 10,000 units will come? 1 lakh rupees amount and they are going to be and face value is 10. So 10,000 units wants to subscribe when new fund offer announce. Secondary market, we want to be buy or sell. If any company announce new fund offer units, it is issued on face value of rupees 10. So basically investment of 1 lakh divided into 10,000 units to subscribe. Now AMC will work trustee on behalf of customer or client. Requirement of AMC will invest in stock market. So basically AMC will contribute money from general public, and as per the criteria they will prepare the plan, and according to the plan they are going to be consider that this much your return and risk, and they are contributing that money and they are going to be invest on behalf of customers into stock markets. Now any return comes from that, they will charge cost to deduct and balance accumulate to as a return to clients. Means AMC will invest in stock market, any returns comes as per the plan they will distribute, but they will charge some things, because in which AMC will not work free of cost on behalf of clients. So they provide financial services, and they also work as an intermediary between stock market and client to debt market. AMC will play link between investor and stock markets. Now determining how that mutual fund, that is, see that investor pull the money with fund house manage with the security market, generate the returns and pass back to the again investors. So how this determine the rate of return, that is when AMC invest in a stock market, maybe in equity, debt or money, they declare dividend, AMC will get returns. So basically when they invest in stock market, if they are going to be invest in equity, so equity they will get the dividend at the annual basis, and AMC will get returns, and simultaneously they buy and sell the share as per the market situations. So mutual fund has having two types of fund, basically that is comes to the income point of view. So they will get dividend and gain. When investor wealth is increased, these are the two reasons, that is where NAV is growing and cash incomes comes to the pictures, and that where we has to be includes when NAV grow means NAV that is net your units has been growing, and basically the income of your as a client has been come to the picture, that is dividend and gains, and that mutual fund has to pass back to the returns, basically as to be considered as a mutual funds. So how the structures of mutual fund, that is unit holders as a mutual fund, that is will be either will be AMC or trustee, and how that AMC will manage the general public related to the custodian, sponsor and transfer agents. So this is will relate to the structure of mutual funds. Then we'll discuss about the today's concept, that is types of mutual fund. Generally types of mutual funds are, as a concept wise we can go for, that is by constitutions and by investment objective, that is open-ended, close-ended interval, investment objective, equity, debt and cash fund. But normally the types of mutual fund has been divided into as a two category, that is open-ended and close-ended funds. So when you study about classification of mutual funds, presently we have more than 11,000 schemes are working in that mutual fund in our nations, and that involves basically at being criteria divided into open-ended and close-ended. When we go for study about that mutual fund has been classified into open-ended and close-ended. So more than 11,000 schemes, and that has been divided into open-ended and close-ended. So let's discuss about how this open-ended and close-ended schemes will be available. So when we discuss about mutual fund products and services, or maybe classifications, so first schemes or first classification that we have to consider, that is as a structure wise how the mutual fund will be classified, that is open-ended schemes. Now basically this name itself, open-ended schemes, means these funds buy and sell units on a continuous basis and allow investor to enter and exit as per the convenience, not for by the AMC. As per the convenience they are going to enter and exit. The unit can be purchased and sold even after the initial offering, that is period. In case of new fund, the units are bought and sold at NAV declared by the fund every day. NAV always declare daily basis at the evening times, and no fixed maturity period is there for open-ended schemes. So the schemes required to declare the NAV on the daily basis, and the investor want to be purchase and sell the securities on their convenience, so they will be enter and exist any times. So this is what related to open-ended scheme, that investor has been come any times, they will be purchased by continuously basis, no fixed duration is there. So they has to be, and they are going to be considered as per the new that is net asset values, and that net asset value, that unit has been will be declared by daily basis. Then these schemes has having the some of the drawbacks. That what drawback is there is large number of investors may try to redeem their units in even negative economic event. So this is the drawback of open-ended schemes. When the economy has been getting negatives, so that times that investor tries to redeem, so they are going to be sell that in a large quantities. So this will be the drawback of open-ended schemes, because they think about that units will not generate in the future. So that will be the drawback of open-ended schemes. Then when we discuss about open-ended schemes, another important things will be come to the picture, that is closed-ended schemes. Now this schemes, specifically the unit of capital of closed-ended funds is fixed, and they sell a specific number of units, fixed duration, which will specified at the time of initial offer only. Unlike in open-ended schemes, funds investment cannot be buy at the units of a closed-ended fund offer. New fund offer, new investor cannot enter for existing investor exist till the term of the same ends. Means the fund will not issue the units of investor after the initial period, and the fund can change duration with consent of investors. Means existing investor, if you want to be existed, after that only you can be enter new investor. That is, new investor cannot enter nor existing investor exist till the terms of the schemes ends. However, to provide a platform for investor to exist before the term, the fund house lists their closed-ended schemes on a stock exchange, and basically the closed-ended schemes are required to declare their NAV on a weekly basis, not a daily basis. That has to be considered as the closed-ended schemes. And no periodic redemption procedures if it is the exchange trade schemes, and the schemes suited for investing in shorter period purpose, and the schemes can be launched when the industry is at the infancy and can be closed when industry mature and growth rate flattens. So based upon the industries launched and will be the matures and growth rates where the closed-ended schemes has been considered. But overall, that how the closed-ended schemes has having, that is they are having fixed maturities. Means when you want to invest, so that maturity will comes to the when the fund has been matured period. So that time only we can be exist from the markets. Then has to go for, that is the difference between open-ended and closed-ended. So as you know about that, open-ended has any time entry and exist, where the closed-ended entry and exist will be restricted. Next difference, NFO, that is new fund offer, will be 15 days entry based upon your new fund offer only. Then post NFO means how we are going to be post NFO will be do buy and sell through AMC only, but here buy and sell list compulsory in listing of stock exchange only. So that is very much important things. And here liquidity will be offered by AMC, asset management company. Means if you want to be withdrawing the things, or maybe we are going to be generating that things, the liquidity offers will be considered by AMC, but here through of exchange platform only has to do that liquidity. And open-ended schemes, there will be no fixed maturity, but here there is a fixed maturity is there. And ultimately sell price at NAV plus load charges, if any, they will charge. So sell price significant premium or discount on the net annual value. So how the sell price will be decided, that is net annual value plus their load charges, and here based upon that significant premium or discount based upon the situations. And availability of these schemes will be the fund itself, and the availability of closed-ended through exchanges only. Intraday tradings will not be possible in open-ended schemes, but in a closed-ended intraday trading will be possible, but it is very expensive. So this is what related to open-ended and closed-ended schemes classification, and how this open-ended schemes and closed-ended funds has been generated. Consider the fact of your the types of mutual funds, the major classification, that is open-ended and closed-ended. So more than 11,000 schemes are working. So how that 11,000 schemes will be considered, that is open-ended and closed-ended. So this is what related to today's videos. I hope you are understood regarding mutual funds classification, that is open-ended and closed-ended schemes. Remaining classification we will discuss in the next video. Please like and subscribe this channel for upcoming videos. Thank you.